Japan's Nikkei stock market index just crashed 12.4% in one single day. This was the worst day for the index since Black Monday in 1987. This massive sell-off is affecting global markets everywhere, with the S&P 500 having its worst day since 2022 and down 6% over just the last 3 trading days. So what's the culprit behind the global crashing stock markets? Well, one of the major factors is the surging Japanese yen. The yen is up more than 10% against the US dollar in just a matter of weeks. This massive move in the foreign exchange markets has caught many traders off guard and led to the blowup of a crowded $1 trillion trade called the yen carry trade. Now you might be wondering what the yen carry trade is. Well, a carry trade is actually a pretty simple concept. It's where a trader will borrow in a country with low interest rates and then turn around and use that money to invest in another country with a higher rate of return. The trade works because you're borrowing money in one currency at an extremely low interest rate, and then investing it in a different currency at a higher interest yield or rate of return. It's effectively an arbitrage trade on different interest rates. And for decades, Japan's yen has been one of the most popular targets of carry trades. This is because the Bank of Japan has maintained near zero interest rates for a long time now, which has made it practically free to borrow money in Japan. This made the yen carry trade one of the most popular and one of the easiest trades on Wall Street. Traders would go and borrow yen, convert it to US dollars, and then buy US bonds or stocks with the money they borrowed. Since interest rates were so low in Japan, it was practically free to borrow this money and pile it into US stocks. Now, a carry trade works extremely well when the currency being borrowed remains cheap and market volatility stays low. And since 2022, the yen has been quickly depreciating compared to the dollar. This meant that the traders who were borrowing the yen to invest in dollar-denominated assets were having to pay even less back over time as the yen's value declined relative to the dollar. When you combine this with the major gains that were taking place in the US stock market, the yen carry trade was making money on both sides of the trade. Shorting the yen was making these traders money, and then buying US stocks was making them even more money. But all of this changed when the Bank of Japan was forced to step in and prevent the value of the yen from continuing to fall relative to other currencies. The Bank of Japan decided to raise interest rates into positive territory for the first time in 17 years. The Bank of Japan raised interest rates by 0.25%, which led the yen to rapidly surge in value compared to the dollar. Since the yen carry trade relies on borrowing yen at extremely low interest rates, this sharp and sudden rise in the value of the yen meant that traders were now losing money by shorting the yen. Now, traders don't want to lose money, and this puts them in a very precarious position. If the value of the yen continues to appreciate, they'll lose even more money by having to pay back all of the borrowed yen at higher prices relative to the dollar. To make matters worse, not only is the yen's value increasing due to rate hikes in Japan, but it's also widely expected that the Federal Reserve will cut interest rates in the US in the near future, which would further weaken the dollar relative to the yen. This is creating a rush for the exits as traders are trying to quickly close their yen carry trades before it turns against them even further and they lose more money. Another major problem is that traders took the yen they borrowed and seem to have mostly used it to invest in the US stock market indices and large stocks like Apple and Nvidia. So in order to pay back the money that they borrowed in the yen carry trade, they have to sell stocks in order to cover their yen short position. With the surge in the yen and the decline in stocks, it's also very possible that some of these big traders are getting margin called right now. This unraveling of the yen carry trade is creating a ton of selling pressure in the global stock market. Traders and banks were using the yen carry as a source of liquidity and free debt to invest in other things. But now that liquidity is drying up and being taken away by the Bank of Japan with their interest rate hikes. This is forcing traders and banks to sell equities and causing a massive decline in the stock market. And it has the potential to create a vicious cycle of selling, because as stock prices decline, traders have less money to pay back the yen they borrowed. In other words, traders are now losing money on both sides of the trade. They are losing on their yen short and on their stock market purchases. This selling pressure could continue, as it's estimated that at least $1 trillion worth of yen have been borrowed from Japanese banks. And it could very easily be an even higher number than that, which is a major risk for the markets. As more borrowers look to pay back this yen quickly before the yen potentially appreciates even further, it could lead to more sell-offs and declines in the market. When you combine the structural issues from the yen carry trade blowing up, with the recent weak employment data in the US and the geopolitical conflict taking place in the Middle East, it's created the perfect conditions for a significant stock market sell-off. Where markets go next from here is anyone's guess, but it's important to be cautious and aware of the underlying market mechanics going on with the yen carry trade unwinding, because it seems that there is a significant loss of liquidity from that. Thanks for watching the video, and be sure to subscribe to the channel for more finance and business content. Thanks.